Hi, I'm Patu from freefincal. In this video, I want to talk to you about a metric known as the Ulcer Index, or in other words, it tells you how much stress it causes to be invested in a mutual fund. So, do mutual funds give you ulcers? Well, it comes that correlation comes because it was believed for a long time that stress can cause ulcers, and later on it was shown that ulcers are caused by a bacteria. The 2005 Nobel Prize was given to it, Barry Marshall, I think. Um, but there is still a debate in the medical community about the correlation between ulcers and stress, whether even though they are caused by bacteria, can stress aggravate it, and so on. um, we will not talk about the debate that happens in the medical community simply because, well, at least I am not competent to do that. But the association of ulcer ulcers with stress comes from there, and therefore there is a metric known as the Ulcer Index created by Peter Martin in 1987. You can go to his website tangotools.com and learn more about it. There is a book on this. The free copy of that, since it's out of print, is available as a PDF there. Peter Martin has developed this index called the Ulcer Index, which is a measure of the stress that an investor would undergo by holding the fund. And the idea is that you want to hold a mutual fund that has got an ulcer index lower than that of a benchmark. So lower the ulcer index, lower the stress. So we'll talk about why the ulcer index, what is the ulcer index, why is it important, and why I'm talking about this. So most of you would know that the standard deviation is a well-known measure of volatility. Higher the standard deviation, higher the volatility in the mutual fund. And the standard deviation is measured in this way. Suppose I have 12 monthly returns, then I calculate the deviation of the January monthly return from the average, the 12-month average, square it. Then I calculate the February return, the deviation of the February return from the annual return, square it, and so on. Add all the squares and take the average and take the square root of it. That's called the standard deviation. The Ulcer Index is measured in a similar way. I'm going to show you how it's measured shortly, but we'll find out why the Ulcer Index is more important, or what extra information it gives you compared to the standard deviation. So suppose you have this sequence of returns, right? These are annual returns, and there's some random sequence, and suppose you calculate the standard deviation of these annual returns, just like the monthly. Instead of using monthly deviation from the average monthly return, here you have to calculate the deviation from the average annual return, and that gives you the standard deviation. Suppose I take the same sequence and sort it in terms of ascending order. That is the lowest return down to the highest return. So this sequence of return is completely different from this sequence of return. But if you calculate the standard deviation, they will both be the same, because the average has not changed, the individual deviations have not changed, the standard deviation will be the same. However, if an investor goes from this annual return to that annual return, and another investor goes from this annual return to that annual return, the journey will be the same in terms of the CAGR, etc., but the risk will be very different. You will agree that this investor, assuming this is an actual return, this investor would have gone through a lot more risk. The Ulcer Index will be able to differentiate between this sequence and that sequence. So Ulcer Index is able to differentiate sequence of returns because it uses something known as drawdowns. So this will have a different Ulcer Index, and if I suppose I sort it in terms of descending order from highest return to lowest return, this will have a different Ulcer Index. So the Ulcer Index is able to distinguish sequence of returns, and therefore has got more information than the usual standard deviation. Whereas the standard deviation for all the three graphs will be the same. Just like the CAGR, it will just be the same. But that's not true, right? Taking a very risky path is different. So how is the Ulcer Index calculated? So the first thing you need to know is what is a drawdown. I have a separate video on this, but I'm going to do it again. So let's say the blue line here is some price that moves up over the years, and the red line here is the maximum. So that's the maximum up to that point, and then there's a new maximum, new maximum, new maximum. So that's the maximum. Notice that there are significant departures from the maximum. That's the all-time maximum at this point, and then it deviates. There's a fall, then it goes back up, and then there is a big fall down, and then it goes back up, and so on. So the drawdown measures these deviations from the all-time maximum, and if you plot the drawdown, it will tell you how much the fund has fallen from the all-time maximum. So you can see here, that's a maximum, and then there's a deviation down, and when there's a deviation below the maximum, the drawdown will be huge. It will drop down from zero. The drawdown is usually negative, so there's a big departure from zero down. So every time there's a big departure down, that means that there is a deviation from the all-time maximum. The fund has fallen down, or the index has fallen down. So to calculate the Ulcer Index, first we calculate the drawdown, then we take the drawdown squared, then so it just inverts the graph, and then it just increases the sensitivity a lot more, but it's always positive now. So notice that when there is a drawdown, the drawdown squared moves up sharply up. And then, just like the standard deviation, what we do is we calculate, in the case of, if I have suppose over a period of 1 year, we take the drawdown for January, square it, drawdown for February, square it, and so on, and then add the squares, take the average, take the square root. So it's the Ulcer Index is defined in a manner identical to the standard deviation, but in standard deviation we are measuring the departure from the average return. Here we are measuring the drawdowns for different periods, and that's the Ulcer Index. And I'm going to show you an example, and this is the reason why I'm talking about this. So what I have here is the sum fund. The blue line is sum fund, and this is Nifty 100 total returns. You can guess what fund that is. So that is the now normalized from June 2013 or so, something like that. And this is the blue line here is the Ulcer Index of the fund, and the red line is the Ulcer Index of the Nifty 100. Notice that this is the Ulcer Index calculated on a monthly basis. This is the rolling Ulcer Index over a monthly basis. And you can see that the Ulcer Index of the fund is largely below that of the index. So the stress level of the investor would be significantly lower. So during situations here when there is a big fall here, the Ulcer Index was significantly lower. So the investor slept a lot more easier, relatively speaking. And then in the recent drop, the Ulcer Index of the fund and the index became comparable though. So I'm now going to, just like I do the monthly screeners using downside protection and standard deviation and monthly returns and so on, I'm also going to include the Ulcer Index into my monthly screeners, possibly from next month, but I will be able to publish some results this month, maybe in a couple of days. And that's the reason I want to make this video. I want to make an introductory video about the Ulcer Index, so it will be useful. So you can use this. So I can now look for a fund that has a track record of having an Ulcer Index lower than the benchmark consistently over the last 1 year, 2 year, 3 year, 4 year, 5 year, and so on, and then choose that fund. Then I will sleep a lot better. Of course, return performance is also important. Just lower Ulcer Index is not important. Good returns, low Ulcer Index would be a nice fund to choose. So that's the reason why I'm making this video. We will talk more about this. So can mutual funds give you ulcer? Mutual funds investing can certainly give you stress, but maybe that stress can lead to ulcers. So you got to be careful. I don't know. So bye bye.